Welcome to All About Money on HKIBC. I am Chloe Feng. Housing is one of the city's most pressing problems. On June the 16th, the Hong Kong Monetary Authority raised its base lending rate by 75 basis points in a lockstep move with the U.S. Federal Reserve, which has adopted an aggressive interest rate policy to tackle inflation. With the cost of borrowing set to rise further, what should homebuyers and property investors do? Tom Ko, the head of capital markets and executive director of Cushman and Wakefield, Hong Kong, joins me to analyze the situation. Welcome to the show, Tom.
Hi, Joey.
It's great to have you. So first, could you run us through the latest residential market performance in the city? So what were the market situations, for example, of the small and medium-sized flats versus the luxury flats, and the new properties versus the second-hand properties?
Actually, the residential transaction in Q1 was the lowest since the COVID. But since the Q2, the restriction eased out. The primary sales, the first-hand sales, drive the market quite a bit, and end-user demand is very strong. Home prices fall a little bit from the beginning of the year, but the rate of decline is moderate. And in recent 1 or 2 months, the price has been normalized recently.
All right, and we've seen that the second-hand market seems to be a driver in the latest situation as well. So tell us more about the details on this.
You mean the second-hand market, right?
Right.
Actually, it's easier for the buyer to buy second-hand since the new finance plan by the financial secretary that even the home price over 12 million, you can still get 80% of the mortgage rate, which helps the transaction of second-hand markets.
Right. And also, can you help us to break down the proportion or the current situation of the small and medium-sized flats versus the luxury flats? So what was the latest market situation on these two?
I think for a small and medium-sized market, they together with the luxury market are going down a bit, but the magnitude for small and medium-sized flat go down more than the luxury one. They go down for about 5%. For the luxury market, it goes down for 3%.
All right. And also the Center City Leading Index, or CCL, which is a gauge of living home prices compiled by Centerline Property Agency, reported the biggest drop in 12 weeks at 0.95% to 180.78 for the week ending on June the 12th. So now with more aggressive interest rate hikes seen in the city, so how do you view the current market sentiment, particularly after the more interest rate hikes being introduced in the city?
I think it has been a consensus that the U.S. will tighten its QE policies and the interest rate will go up for the remaining of the year. But as you can see, the banks in Hong Kong still keep the prime rate in a stable level. And in the near term, the impact on the market sentiment is not very severe. And I think for a home buyer, the mortgage length is about 20 to 30 years. There must be ups and downs in interest rate. The only problem, they have to be cautious under the stress test.
So you're saying currently the magnitude from the interest rate hike is still manageable for the city's property market, right?
Yes.
Got it. And also, as you already mentioned, like the major banks in the city have opted to keep their prime lending rates unchanged, giving some mortgage borrowers some breathing room until the next interest rate increase. But do you think the local banks might, further increase their prime lending rate. In the second half of the year, shall we see more of the interest rate policies being introduced?
Definitely, given that if the U.S. do increase their interest rate, because most of the HIBOR plan mortgage in Hong Kong is HIBOR, 1 month HIBOR plus 1.3%, which is capped at prime rate minus 2.5%. So theoretically, if the HIBOR, 1 month HIBOR hits 1.2%, then the bank have to move the prime rate a little bit, which will be seen by the end of the year.
Right. You mean 1.2%, right?
Yeah.
All right. And just like you mentioned, the Hong Kong Interbank offered rate or HIBOR has seen their repayment. A lot of the home buyers in the city whose mortgage is linked to HIBOR had seen their repayments go up since March. And on Monday, however, the 1 month HIBOR was already more than doubled to 0.61% from 0.28% when the U.S. Federal first raised its interest rates for the first time this year on March the 17th. And the 3 month HIBOR also rose 6 basis points to 1.35%, marking the highest level in over 2 years. So how would this current level impact the local residential property market? At what point should the investors or the home buyers be more alerted about the level?
Given the current level, the interest rate would marginally affect the monthly repayment. As I said, a bigger impact will be on the mortgage stress test. It's harder for a new home buyer to pass the stress test, given the interest rate is getting higher. And because our linked exchange rate system, eventually, by the end of the year, we have to follow, our HIBOR has to follow the U.S. interest rate. It's only a matter of time. And we believe the primary market will drive the transaction in the remaining of the year, since the developer can give more incentive or more down payment plan, which will facilitate the home buyer, given that the interest rate is getting higher. And for us, I think the home buyer has to reconsider the financial and risk-taking ability, given the high uncertainty in a mix of factors like pandemic, geopolitical tension, and global supply chain shocks.
Right. And also, Tom, I'm thinking, do you have any forecast on the HIBOR performance later on this year? For example, what kind of pace it might show to us?
I'm just mimicking what the market's saying, that right now, the U.S. Fed Fund rate is 1.75%. And we are seeing 4 increase in the remaining of the year, like in July, September, November, and December. And in July and September, it probably go up another 75 basis points for 2 times. Then we got 3.5%. And for November and December, we probably see 0.5% each. So at the end of the year, probably the interest rate in U.S. will go up to around 4%. And by that time, our HIBOR rate, 1 month HIBOR rate, will be around that level.
Wow, that's a huge increase as well. And also, Tom, tell us more about your forecast on the city's home prices performance in the second half of the year following this kind of trend. Can you also give us some examples on specific property projects in the city and its price trends?
Okay. As I said, the property price for the general market goes down to 3 to 5% in first half, and we believe that the market is picking up, given there is a lot of pent-up demand, and we are seeing that there will be something like 3% price increase in the remaining of the year. And by different real estate, something like CD1 Sha-Tin, which is a smaller lump sum unit, would drop by 4%, whereas Cushman, which represent the mid-market, it goes down by 5%. But for luxury residential, like residence Bel Air, which decreased only by 3%. And in other words, we think all the lost ground will be recovered in the second half.
All right, that's sort of some relief as well, I believe. And also, Tom, tell us, because I've seen your company report, is saying that the urban renewal is also one of the drivers for the city's property market. So tell us more details on this.
Because the government is considering lower the threshold for the compulsory sale. I think it will probably pass next year, which will lower the threshold from 8% or to 70%, which will help the urban renewal in the urban area in the coming years.
Right. And I guess maybe investors can also try to take advantage of these new opportunities offered by the government initiative as well. All right, thank you so much for your analysis, Tom. Let's take a short break. Coming up next, we'll have more discussions on the city's real estate investment situation, so do stay tuned.
See you.